What if the latest financial updates have the power to fundamentally alter your perspective on two of the world's most intriguing currencies, the Iraqi Dinar and the Vietnamese Dong? This is precisely the moment we find ourselves in. October 2025 is bringing to light data and structural updates that are markedly different from anything the foreign exchange world has observed in recent memory. This isn't the familiar territory of online speculation or recycled hearsay. This is a formal disclosure from within the professional Forex sphere that mandates a genuine reevaluation of the conversation, whether you've been closely following the journey of currency revaluation for years or are just beginning to explore the complexities of international Forex markets. The intense global focus now directed at the Iraqi Dinar and Vietnamese Dong demands serious and considered attention. For a long time, both currencies were routinely dismissed by mainstream financial commentators, largely because of the enduring political complexities in Iraq and the traditionally cautious pace of economic reforms within Vietnam. These established narratives are now being challenged by a fresh wave of structural developments that suggest these prior assumptions may no longer accurately reflect the underlying realities. A recent, highly detailed report has emerged from the Iraqi Gazette, a publication known for its rigorous analysis, which has dedicated comprehensive coverage to these two historically undervalued currencies. This analysis is providing an unprecedented level of visibility into their potential trajectory. This isn't merely surface-level commentary. The report is rich with detailed charts, in-depth historical trend assessments, and a close examination of key macroeconomic indicators. It illuminates underlying significant shifts in monetary policy, gross domestic product, GDP, growth, foreign reserve accumulation, and trade balances for both nations. The evidence presented suggests a quiet, deliberate change in strategy. For example, Iraq's central bank has been strategically working to strengthen its foreign currency reserves and fine-tuning its monetary instruments with the explicit aim of stabilizing the dinar. Simultaneously, Vietnam has been initiating structural reforms designed to allow for greater currency flexibility and to make the nation a more attractive destination for international foreign investment. These fundamental structural adjustments often fly under the radar in the frenzy of daily financial news cycles. Yet they are crucial. They form the very bedrock upon which plausible revaluation scenarios are built when a highly credible and widely respected financial publication chooses to commit this level of in-depth analysis to currencies that have long been relegated to the high-risk category. It serves as a powerful signal. It indicates clearly that the most serious and informed participants in the global market are dedicating substantial attention to these assets. This particular depth of coverage carries enormous significance because the colossal trillion-dollar global foreign exchange market has a tendency to react strongly when previously marginalized currencies transition into the mainstream dialogue, often well in advance of fully publicized policy changes or widely recognized global economic shifts. Crucially, the new report from the Forex Gazette does not rely on purely speculative arguments. Instead, it utilizes empirical data to demonstrate why both the Iraqi Dinar and the Vietnamese Dong may be nearing a period of transformational movement. Central to this comprehensive analysis are charts illustrating long-term purchasing power parity, currency velocity, and comparative inflation trends. These quantitative measures collectively demonstrate that both nations' currencies are demonstrably undervalued relative to the current strength of their economic fundamentals and underlying national production. Focusing on Iraq, a declining reliance on oil revenues, coupled with the establishment of key strategic foreign partnerships, strongly suggests that a program of macroeconomic stabilization is genuinely underway. This stabilization effort provides a tangible and plausible foundation for any future revaluation efforts. In contrast, Vietnam has experienced consistently rapid export growth and has significantly fortified its banking infrastructure. These achievements are boosting investor confidence and creating the necessary groundwork for a more flexible and market-responsive Dong. The report achieves a narrative that is far more rigorous than typical revaluation rumors by carefully examining historical exchange rate fluctuations, cross-border trade volumes, and the deliberate accumulation of reserves. A key takeaway is that this level of transparency and insight, which is strictly backed by data, simplifies the process for serious investors to properly assess both the risk and the potential reward involved. It allows them to clearly distinguish between informed, well-researched speculation and mere anecdotal hype. Financial publications seldom devote such extensive coverage to currencies outside the major global players like the euro, yen, or US dollar. Therefore, the Gazette's committed focus on the dinar and the dong signals a profound and meaningful shift in institutional perception regarding their future prospects. The report's inclusion of strategic recommendations, complete with scenario planning based on both historical and predictive modeling, underscores a critical point. These currencies are no longer mere curiosities for niche collectors. They are being presented as emerging assets that warrant careful and considered evaluation by both large institutional investors and individual Forex enthusiasts who are seeking early insight into potentially high-movement markets. The deep, data-driven implications of this coverage are substantial for every type of observer, from the casual reader to the professional trader assessing risk models. Investors who have historically dismissed the Iraqi Dinar or Vietnamese Dong, often seeing them as low liquidity or overly speculative instruments, may now find themselves compelled to reevaluate their positions, informed by the hard evidence systematically presented in the report. Historical examples from other emerging market currencies repeatedly demonstrate that the early recognition of structural reforms often precedes a period of significant currency appreciation, thereby creating substantial profit opportunities for those who operate with informed foresight. This concept is central to understanding the current environment. For instance, a meticulous analysis of Iraq's monetary stabilization efforts, combined with evolving geopolitical stability and a marked increase in transparency regarding the reporting of foreign exchange reserves, constructs a compelling and logical argument for the dinar to be considered an undervalued asset poised for potential growth. Similarly, Vietnam's consistent and systematic integration into complex global supply chains, coupled with a deliberate, gradual liberalization of the dong, suggests that key market forces are aligning to reward the earliest adopters who are focused on macroeconomic fundamentals rather than chasing unreliable, anecdotal hype. Beyond the decisions of individual investors, this high level of attention from credible and widely read financial outlets can, in and of itself, act as a significant influence on broader market dynamics. Liquidity often improves as a greater number of professional participants begin to monitor the currencies, and the efficiency of pricing increases due to the wider dissemination of reliable, accurate data. In essence, the coverage functions as both a crucial market signal and a powerful catalyst, effectively elevating these previously under-the-radar currencies to a level of institutional scrutiny that is typically reserved only for the world's most established global financial players. For anyone interested in the dynamics of foreign exchange speculation or engaging in long-term international investments, the present moment represents a unique combination of potential opportunity and the responsibility to conduct thorough, informed analysis. It's a point where objective data can effectively separate a strategic, carefully planned market positioning from mere random guesswork. Iraq, at this very moment, is undergoing an extensive, fundamental, transformative overhaul of its entire financial infrastructure. This large-scale shift holds significant implications for the dinar's stability and its potential for revaluation in the near future. According to the insights presented in the Forex News Gazette report, these systematic changes are far from minor upgrades or cosmetic adjustments to the current system. Instead, they represent a nationwide modernization of the entire banking system, spearheaded by the implementation of cutting-edge digital banking frameworks. These advanced frameworks are designed to seamlessly integrate real-time transaction processing, ensure complete compliance with stringent international financial standards, and incorporate sophisticated biometric security features to protect assets and identities across the entire network. The sheer scope of this modernization effort is comprehensive, designed to reach even the most rural and remote areas where access to formal banking services has historically been either extremely limited or entirely unavailable. The expansion of mobile banking solutions is a key part of this initiative, offering previously underserved populations the essential ability to actively participate in formal financial systems. This increased participation is considered absolutely critical for both sustained domestic economic growth and for bolstering international investor confidence in the nation's financial stability and reach. The specific financial terminology carefully used in the report including terms such as rate realignment and economic modernization, is particularly noteworthy because such language is frequently employed as a deliberate precursor to planned currency adjustments. The report also places a strong emphasis on Iraq's efforts to actively stabilize liquidity across its systems, significantly strengthen its management of foreign reserves, and systematically increase transparency in all of its financial reporting, all of which are widely considered key, reliable indicators for a potential currency revaluation in the foreseeable future. By successfully positioning its banking sector as a reliable, technologically advanced backbone of the national economy, Iraq is sending a clear and unambiguous signal to the global community that it is profoundly serious about systemic reform and achieving long-term stability. If these crucial efforts are sustained and successful, the robust groundwork being laid could support not only significant internal economic expansion but also cultivate a far more confident and credible international perception of the dinar. This would potentially create the necessary conditions favorable for a carefully measured and sustainable currency appreciation. On the other side of the equation, Vietnam, which has long been acknowledged globally as a dominant manufacturing powerhouse in Southeast Asia, has historically maintained its currency, the dong, artificially pegged at comparatively low levels against the US dollar for many decades. Despite the country's truly rapid economic growth and its highly successful expansion into complex global trade networks, financial analysts have often pointed to the dong's significant undervaluation relative to the undeniable strength of Vietnam's economic fundamentals. But the new report hints at something more deliberate and strategic, a valuation breakout. This meticulously chosen phrase, emphasized by the Gazette, strongly implies a series of strategic and carefully controlled adjustments rather than any sudden, sensational headline-grabbing movements. Vietnam's core economic indicators robustly support this deliberate, measured approach. The nation consistently maintains significant trade surpluses, reliably attracts substantial inflows of foreign direct investment, and successfully manages to keep inflation rates relatively low and consistently stable. Combined, these fundamental factors actively create the ideal economic conditions for a gradual revaluation of the dong, executed in a manner that strengthens the currency while simultaneously minimizing any potential market disruption. The report takes care to emphasize that this is not a speculative gamble or a short-term, unsustainable intervention. It is described as a stealthy, methodical process explicitly designed to enhance the currency's real underlying value over an extended period. From a strategic Forex perspective, this means that astute investors who are paying close attention to these structural developments now could potentially position themselves advantageously ahead of the main market adjustments, thereby benefiting from the early recognition of emerging trends that will only gain widespread visibility as the process of realignment slowly unfolds. The overarching narrative portrays Vietnam as strategically managing its currency to align its value more closely with its undeniable economic realities, signaling a growing level of sophistication in its monetary policy and fostering increasing confidence among international investors. One of the central and unifying themes of the report is the profound strategic importance of sustained regional stability as a non-negotiable prerequisite for any meaningful currency adjustments. Both Iraq and Vietnam are demonstrably making significant and measurable strides in this highly critical arena, demonstrating political will. Iraq, a nation long associated with geopolitical turbulence, has been steadily improving its diplomatic relations with various neighboring countries, actively working to reduce cross-border trade restrictions, and making concerted efforts to mitigate long-standing tensions with regional powers. These are more than mere political gestures. They are moves that actively create a stable operating environment, where foreign investors and large multinational corporations can operate with significantly greater confidence. This directly supports the long-term strength and overall credibility of Iraq's banking and monetary systems in the global context. Concurrently, Vietnam has maintained an impressive and consistent track record of internal political calm, a foundational element that has been instrumental in successfully attracting numerous international companies relocating their operations from higher-cost regions into the country's rapidly expanding industrial hubs. Both nations are effectively complementing these critical efforts with the substantial strategic accumulation of foreign reserves, Iraq is actively stacking gold and US dollars, while Vietnam reinforces its strong economic position through consistent trade surpluses and the ongoing inflows of foreign investment capital, far from being random occurrences. These reserves serve as absolutely critical economic ammunition, providing their respective central banks with the necessary capacity to intelligently intervene in the currency markets, effectively stabilize their exchange rates when necessary, and execute carefully controlled reevaluations when the strategic timing is deemed appropriate. This calculated combination of heightened political stability, increased trade openness, and the deliberate accumulation of reserves signals forcefully that both Iraq and Vietnam are actively creating the foundational conditions for sustainable monetary reform. This greatly increases the measurable likelihood that their currencies could see strategic adjustments in the foreseeable future. The entire approach demonstrates a calculated, step-by-step methodology carefully designed to simultaneously protect their domestic economies while robustly enhancing international confidence in their financial systems. This comprehensive effort is laying a robust and dependable foundation for what may very well become one of the most closely watched currency evolutions in recent financial history. Another crucial but often underreported aspect that is highlighted extensively in the professional report is the vital role of public education in thoroughly preparing the citizens of both nations for upcoming shifts in currency usage and financial systems. Both Iraq and Vietnam have deliberately launched comprehensive, nationwide campaigns with the explicit goal of significantly increasing financial literacy among their populations, a strategic move that reflects a highly modern and forward-thinking approach to systematic economic modernization. These broad-based programs meticulously educate citizens about the practical use of smaller currency denominations, the functionality of digital wallets, basic banking operations, and the critical principles of inflation management. Such large-scale initiatives are never implemented lightly. Governments typically only invest in such broad educational campaigns when they are actively planning major structural changes to their core monetary systems, by effectively teaching their citizens how to capably navigate modern financial tools and clearly understand the underlying dynamics of inflation. These education campaigns actively lay the essential groundwork for the much smoother adoption of future reforms. Whether those reforms come through an eventual currency revaluation, the planned introduction of new denominations, or the inevitable expansion of digital banking services. In Iraq, this foundational work means empowering rural and previously underserved populations to participate fully and meaningfully in the national economy. In Vietnam, it helps ensure that the rapid pace of industrialization and the substantial foreign investment flows seamlessly translate into effective domestic financial participation for all citizens. The quiet, deliberate nature and measured pace of these public education campaigns mirrors the strategic, non-flashy monetary adjustments that are currently under discussion. There are no overly sensational announcements or sudden disruptive moves. There is only a careful, methodical preparation designed to ensure the entire population is ready for a major, inevitable financial transition. From the perspective of an international investor, these sophisticated education initiatives serve as a subtle, yet exceptionally powerful signal that both nations are genuinely serious about creating the necessary conditions for a controlled, orderly transformation in how their currencies function and are universally perceived, further strengthening the case for a significant potential revaluation in the medium to long term. The sustained flow of foreign capital provides one of the clearest and most tangible confirmations that Iraq and Vietnam are actively entering a profound and serious phase of financial evolution and modernization. In Iraq, numerous foreign banks that had long neglected the region are now actively re-establishing crucial relationships with the central bank, a strong signal of renewed confidence in the country's evolving regulatory environment and its long-term economic prospects. This marked shift in sentiment is prominently mirrored in the vital oil sector, where sustained international investment is now driving a significant boom in critical infrastructure and energy projects, consistently reinforcing the absolute centrality of Iraq's oil revenues to its potential currency strength. Similarly, Vietnam continues its highly successful streak of attracting substantial foreign capital, with a particular concentration in the manufacturing and infrastructure development sectors, As vast multinational corporations increasingly choose to relocate their complex operations from higher-cost regions to the established, efficient Vietnamese industrial hubs, these powerful trends are far from anecdotal. They reflect a deep institutional confidence in markets that casual, less informed observers often inaccurately dismiss as overly risky or fundamentally underdeveloped. Large-scale investors and global financial institutions rarely chase fleeting rumors. They strategically position their capital only where objective data and solid fundamentals strongly suggest a sustainable, long-term opportunity for growth. The strategic injection of these large-scale foreign resources actively strengthens domestic liquidity across the systems, reliably reinforces foreign reserves, and indirectly but substantially supports overall currency valuation stability. When capital allocation occurs at this significant scale, it frequently precedes major structural adjustments. In monetary policy, because well-informed, institutions consistently anticipate and proactively respond to both increasing political stability and the implementation of strong macroeconomic reforms. For both Iraq and Vietnam, these strong foreign capital flows are not just a minor financial footnote. They are a tangible and highly visible indicator that the entire international financial community actively recognizes the latent, untapped potential of these currencies. In simpler terms, where casual, uninformed speculation may only perceive uncertainty and risk, sophisticated institutional actors clearly see strategic openings for substantial growth, powerfully signaling that both nations are firmly on the radar of serious high-level market participants. The current exchange rates vividly illustrate just how remarkably undervalued the Iraqi Dinar and the Vietnamese Dong remain, especially when measured against the clear strength of their underlying economic fundamentals. The dinar currently trades near 1,300 IQD per US dollar, while the Dong sits at approximately 23,500 VND per US dollar. These specific rates have remained notably stable for an extended period, which has, unfortunately, contributed to a false sense of unchangeable predictability for many casual observers. However, the Forex News Gazette report highlights the crucial point that even a partial floating of the Iraqi dinar could dramatically shift its valuation, with the potential of moving closer to par with the US dollar. This bold projection is firmly grounded in Iraq's substantial oil revenues, its rapidly growing foreign reserves, and its significantly strengthened banking infrastructure, all of which provide tangible, verifiable support for a potential significant currency realignment. In the case of Vietnam, professional analysts project a measured series of gradual adjustments that could appreciably strengthen the Dong over a sustained period, accurately reflecting the nation's consistent trade surpluses, its massive foreign direct investment inflows, and its successful controlled inflation management. Importantly, these projections are firmly based on professional institutional models and are not the product of speculative rumor. When highly respected financial institutions publish specific numerical ranges and calculated probabilities, they are signaling to the entire market that a realistic, measurable potential for currency revaluation exists, making these projections materially different from casual online speculation. In practical, actionable terms, these hard numbers clearly indicate a crucial turning point. Informed investors now possess quantitative evidence that these currencies are fundamentally undervalued, while the respective governments have demonstrably acquired the necessary tools and reserves to responsibly implement managed adjustments. The powerful convergence of institutional modeling, sustained foreign investment, and thorough macroeconomic preparation makes this development one of the most intensely scrutinized developments in the entire emerging market Forex landscape today. Skepticism surrounding the potential revaluation of both the Iraqi Dinar and the Vietnamese Dong is, of course, entirely understandable. For many years, various online forums, social media chatter, and speculative newsletters have aggressively circulated often unsubstantiated promises of sudden currency windfalls, almost always entirely lacking in credible data or professional substantiation. Many casual observers have been financially impacted by overhyped predictions that have consistently failed to materialize, leaving a lingering weariness and caution among those who closely watch emerging market currencies. However, the current financial scenario is fundamentally different due to the exceptionally high quality and professional caliber of the source. The Forex News Gazette, a publication widely respected and read by professional economists, institutional investors and professional traders worldwide, has dedicated comprehensive, full-scale coverage to these two currencies. Unlike the pervasive rumor-driven chatter, this professional report is deeply rooted in verifiable evidence. It explicitly references central bank data, key macroeconomic indicators, detailed professional charts, and sophisticated institutional modeling. Professional analysts have meticulously traced the systematic reforms, the steady foreign reserve accumulation, the trade dynamics, and the specific monetary policy adjustments, thereby producing a rigorous framework for understanding not just the abstract possibility of currency revaluation, but the actual, measurable probability of it occurring under current conditions. The fundamental difference between this professional analysis and the prior waves of speculation is exceptionally significant. When an institution of this professional caliber signals systemic reform, and that signal is strongly backed by verifiable data and high-level professional analysis, it creates a reliable, actionable signal for the global markets. In other words, this is not mere hype strategically aimed at stirring online attention and speculation. It represents a documented, tangible shift in professional institutional thinking about where these currencies could realistically and sustainably move in the medium to long term. For both investors and policymakers who are paying close attention, this development marks a critical inflection point in long-term currency strategy development. Beyond the immediate concerns of monetary policy and direct capital flows, both Iraq and Vietnam are strategically leveraging advanced technology as a foundational pillar for their ongoing currency modernization efforts and the enhancement of their overall economic resilience. In Iraq, blockchain technology is currently being integrated into the core national financial infrastructure, providing crucial transparency, enhanced security, and robust traceability for a wide range of transactions. Mobile wallets and biometric-enabled ATMs are being actively rolled out across both urban and rural regions, meticulously creating a comprehensive network that allows all citizens and businesses to interact seamlessly with both the domestic and the international financial systems. These technological innovations are not implemented merely for superficial convenience. They are strategic tools carefully designed to actively build public trust, dramatically improve transaction speed and efficiency, and significantly enhance necessary regulatory oversight. Vietnam is simultaneously pursuing highly similar objectives, strategically embedding enhanced transparency requirements into its key international trade agreements, actively modernizing its national payment systems, and ensuring full, seamless compatibility with all major global financial networks. Both nations are powerfully signaling a forward-looking mindset. They are not merely preparing for the constraints and realities of today's economy, but for a future in which digital finance, secure, transparent transactions, and deep global integration will be the defining features of national economic competitiveness. By successfully combining technological modernization with systemic policy reforms, strong foreign investment inflows, and the sustained accumulation of reserves, Iraq and Vietnam are actively creating the necessary economic conditions where their currencies are properly positioned to accurately reflect their true underlying economic value. For professional investors, this significant convergence of advanced technology, sound policy, and capital represents a strong and compelling indicator that these emerging market currencies could experience meaningful, well-managed appreciation over a considered period of time. Perhaps the single most compelling piece of evidence suggesting serious market anticipation comes directly from the report's coverage of forward contracts. Major European financial institutions are already in the process of drafting and establishing structured agreements for future trades in both the Iraqi Dinar and the Vietnamese Dong. Unlike casual speculation or the less-informed retail-driven hype, forward contracts are precise, structured financial instruments specifically designed for sophisticated hedging and professional risk management strategies. These highly specific contracts are only employed when professional investors and large, multinational institutions actively anticipate and plan for measurable changes in currency value. They are not random bets but are instead strategic, sophisticated financial tools specifically intended to lock in future positions well ahead of anticipated market movements. The crucial fact that these specific agreements are actively being established today indicates strongly that sophisticated insiders are not simply debating whether value changes will occur. They are actively planning around the precise timing, the expected magnitude, and the calculated risk of those changes. In practical terms, this active use of forward contracts is a direct and unambiguous signal that knowledgeable market actors clearly see a probable revaluation or a carefully planned series of adjustments in the immediate future, and they are proactively preparing to act accordingly with committed capital. This is particularly noteworthy given the long-standing, often outdated perception of these two currencies as either stagnant or simply too volatile for any serious institutional consideration. The active structuring of professional forward contracts suggests strongly that the underlying fundamentals, including banking modernization, reserve accumulation, foreign investment, and political stability, have now definitively reached a crucial threshold where professional investors are confident enough to commit substantial capital using precisely defined risk strategies. In short, the active forward contract activity provides a rare, tangible, and highly reliable indicator that these currencies are now firmly on the radar of the global financial community, effectively moving from the realm of purely theoretical potential into a sphere of actionable high-probability reality. Looking at the broader, encompassing picture, the sharp contrast between the past widespread skepticism and the current structural developments is nothing short of striking. On one hand, Iraq and Vietnam have historically operated under tightly pegged exchange rates, with concerns over inflation and perceived instability often limiting broader investor confidence. On the other hand, the most recent evidence strongly points to a coordinated, multi-layered, and deliberate approach to fundamental modernization and monetary reform. Iraq's sweeping, system-wide banking upgrades, its rapid technological integration, and its deliberate foreign reserve accumulation all align perfectly with a considered strategy to significantly strengthen its domestic financial systems and robustly enhance its international credibility. Vietnam, meanwhile, is continuing its steady, consistent path of accumulating trade surpluses, attracting substantial foreign investment inflows, and launching targeted educational campaigns specifically designed to prepare its citizens for subtle but financially meaningful currency adjustments. The active addition of professional forward contracts into this complex mix signals unequivocally that serious institutional players are already strategically positioning themselves around the expected value shifts. The powerful convergence of all these crucial factors: modernized infrastructure, stable and predictable macroeconomic policies, widespread technological adoption and informed citizenry, and proactive capital positioning, creates a plausible scenario in which mere speculation gives way to measurable, quantifiable probability. The financial crossroads is now abundantly clear. These currencies are no longer passive players within the global markets. They are moving deliberately forward, with highly coordinated policy, clear investor backing, and sophisticated professional modeling actively shaping their precise trajectories. For anyone tracking the complexities of emerging market Forex, Iraq and Vietnam collectively represent a rare and compelling case where long-ignored currencies are being methodically and transparently readied for a major potential revaluation, combining both structural preparedness and tangible market anticipation. The question now facing every observer, investor, and market participant is straightforward. Are you waiting for the inevitable official confirmation? Or can you accurately interpret the powerful writing on the wall based on the data already presented? Historical patterns consistently show that meaningful shifts in emerging market currencies rarely announce themselves politely or with ample warning. They accelerate dramatically once the critical conditions are firmly in place, and those who hesitate risk being left behind as the movement unfolds. Iraq and Vietnam are collectively providing numerous signals that are increasingly difficult to dismiss: sweeping banking reforms, deep digital integration, deliberate reserve accumulation, consistent trade surpluses, strong foreign investment inflows, targeted public education campaigns, and now, even the strategic forward contract positioning by large institutional players. Each of these strategic moves is significant in its own right, but when taken together, they form a highly coherent and compelling picture of deliberate, methodical preparation for a major potential currency revaluation. This is not the familiar world of speculative chatter. It is a powerful confluence of policy, technology, and sophisticated market behavior, all pointing toward a critical inflection point in their financial histories. While the official, formal confirmation from central banks or government authorities may still take time to materialize, The foundational structural groundwork strongly suggests that the trajectory for change is already firmly set, and moving forward, those who carefully monitor these evolving developments, meticulously analyze the released data, and correctly interpret the collective signals stand to understand the emerging opportunity well before it achieves widespread public recognition. The overarching lesson here is clear and instructive. Financial movements of this significant magnitude rarely wait for public consensus. They are designed to reward foresight, rigorous preparation, and disciplined, objective observation. Therefore, it is essential to remain highly informed. Stay acutely attentive to all the macroeconomic indicators, and recognize that when these changes ultimately occur, they will likely move with speed and decisiveness, positioning those who are ready to act in the strongest possible position to potentially benefit.